Hi everyone, welcome to our market talks. So these 2 weeks were pretty amazing. We have this bounce and based on uh, shrink in volatility, we see that people are actually buying the dip. So I think that the question for today's show will be, will this dip last, and is it really a dip? Because all major indices are still very far away from their recent highs, and also uh, not bullish trends. I see that NQ is neutral now, but on this volatility ranges are very wide, and I'm sure we have a lot to talk about. Okay, so today I will start. We have a lot of confusion from people and a lot of questions about what I actually was tweeting and about correlations and how to use the tool to come up with proper signals. So first I will start with some news, and then I will explain um, the correlations again, because maybe it was a mistake that I stopped talking about that, because I was thinking that I was talking about correlations for 2 years straight, but maybe I still need to repeat that, and maybe to add some more information on how I interpret that and use it. So I will share my screen. I'll share my screen. Uh, First of all, there are some news from my fractal range camp. Uh, Here is a beta testing environment. So what I will show you is still not available for users, but it will be available very, very soon. So for our elite subscribers, we are launching a futures page, and that page will grow. For now, I'm adding a list of most liquid and most important futures from both CME Group and the Eurex, which is a European futures exchange. So there will be available, of course, all major indices, including ES, NQ, DAX, Stocks 50, French CAC 40, and others. Also, think fixed income futures, both from Europe and the US. Yeah, this page will be available on our elite subscription. I think that futures are very important thing to watch, even for those who are not trading futures. So I'm sure it will be useful. And of course, then we will be able to go to ticker page and see all the available information. For those futures that have option chains, there will be implied volatility data. There are still a couple of things to fix. So related to volume, I will fix it in upcoming days. We plan to release this feature maybe next weekend or so, but we will let you know. So here, these are the news that I'm excited to share. Now, about what's going on, and of course, I will give a little bit of hindsight, because it will I will not be able to avoid that, because for you to be able to explain what happened, actually we will look at what happened in the past. So yeah, I hope it will be helpful. But as I always recommend, for people who follow our process and are working on their own and watching signals, first thing you need to do is actually every day, before you look in for ranges, trends, and other changes, you need to go to correlations page. And the correlations page actually has a lot of information that is very important. And so today's goal, before I start talking about my overall views, what I'm thinking for the next 2 weeks regarding trading, first I will talk about what happened and how I interpret these. So the most important correlations to start with are stock bond correlations, because stock bond correlations for us these are telling us what regime we are in. And I know that a lot of people already are familiar with the fact that negative stock bond correlation is more of a normal regime. So that's what you would expect from stock bond correlations. You expect them to be negative, but what one part that people is missing is not only the changes in correlation and to which direction we are moving, but also which asset is leading. And today I will stress a lot about that. What I mean is when you get a negative stock bond correlation, you should actually first look for signals for bonds, because if you see that correlations are going down or even are already negative and moving down, but TLT, for example, just turned bullish and the upside downside ratio is in your favor and so on, then you should reverse your thinking, because in normal regime, a lot of people think, okay, stock bond correlations negative, it means normal regime, buy stocks and happy life. So not exactly. You buy stocks if stock bond correlation is negative and stocks are outperforming bonds, and signals for stocks are more bullish than for bonds. I hope this thing is clear. So first of all, I will show a couple of charts that I want to. Yeah, so here I have rolling 10-day TLT correlations versus SPY, and also I will open another table which is actual time series of the correlations for the last month or so. So what I want to say is that the rate of change is very important, and you need to write those down every day, or plot them in Excel or somewhere. We will add it on MFR as well. But when correlations are positive and moving up, the regime is of positive stock bond correlations, and I will explain what that regime is and what to do. But we see that correlations peaked actually in the end of July. From this time series, we see that actual peak was July 31st, was the stock bond correlations were 0.68, and then they started reducing. And then I tweeted that they are collapsing. Actually, this was the sign. So, like I said, today will be more about a hindsight, because I can't stress that enough how important it is in my process and of course in my opinion. So I want people to really understand what to look for. So you don't wait for correlations to get negative. When you see that these correlations are going down, it's already a sign. It's already a sign that things are starting to change. And then, of course, when they are going negative, you also check whether they are reversing or they are continuing to go lower and lower and lower. This rate of change is very important. And again, there was a question, which period correlations to start with. So I always start with 10 days and then move to 30 days. 5-day correlation is the last, because that one is very choppy. But we see this on 10 days, and actually we see the exact same thing on 30-day correlation. We see the exact same thing on 30-day correlations. Now I'm opening the chart. Here it is. Here it is. Yeah, sorry about that. And of course, 30-day correlations are slower. Same applies for any signal or any indicator which has a higher look back period. The higher the look back period, the slower it moves. But the peak was here, and every single day I write them down and write the rate of change of those. And whenever you see that stock bond correlations are actually decreasing, not necessarily negative, decreasing, that should be the first warning sign. Later I will show you more warning signs, but that would be the first warning sign for you to maybe maybe reduce your risk. Reducing risk means different things for different people depending on their portfolios, of course. But reducing equity positions is a very, very smart decision. So now we have some dates. We have dates that, for example, 10-day correlation peaked in the end of July and then started to go down. So then you check fixed income signals. So in this case, it's TLT, but of course, SHY and other proxies are also important as well. But even because some people say, oh, I only trade equities or I only trade equity ETFs or whatever. Everyone who is in this business for a long time and understands the relationship between different assets and capital flows, because this is what it is, it's capital flows, understands that equity trader always needs to monitor fixed income. Even if you have no interest in buying or selling TLT, doesn't matter, it will save you a lot of money. So what you had to look for is that TLT is bullish trend for quite a while. Yeah, we had one day of neutral, and even before July 5th, it was neutral for a couple of days. But for me, when any asset switch from bearish to neutral is like a get ready mode. I still usually wait for asset to go from neutral to bullish. But then you see this, correlations are going down and bonds are bullish. And at the same time, we can compare it on a chart that stocks were weak. Stocks were basically at their all-time highs, but those who watch order flow know that the last days at all-time highs were very weak. Very weak, it means market tried to push forward, but it failed. But this is not a process. I'm not telling you people to watch order flow. It's not. I mean, no one needs that. Only day traders need that. But the momentum in stocks was already weakening. So first, so if stock bond correlations are going down, and even better, going down and negative, and bonds are bidding. So you see in the signals that there are trends and momentum for bonds that is signaling bullish. Then it's not the time to buy stocks. And again, I will take responsibility because for a couple of shows I was talking that I will stay in cash, I will not buy stocks. But actually, these were the reason. These were the reason. Bonds are bullish. Even when the stock bond correlation was positive, and I just showed you the chart, that it was positive and going up for quite a while. Even then, it's important to watch bullish signals for bonds. But at least when you know that everything is highly correlated, at least you know that you can still stay in equities for a while. And actually, there are even hedge fund strategies that are very, very simple, but works quite well, which basically what they do on a monthly basis, if stocks outperform bonds for the last 12 months, you keep stocks for one more month and then repeat over, because they understand this correlation. When bonds start outperforming or catching up to stocks, it's the first time that you need to reduce risk. It's the same approach, but on a longer term basis for a strategy example, for those who are doing active portfolio management. But first, I wanted to stress that. And I hope it answers a lot of questions. Because a couple of years ago and a year ago, when we were doing these shows, we were in completely different environment. So when the market crashed in 2022, it was crashing with positive stock bond correlation. So again, the conclusions are different. Here, conclusions are that, okay, when this crash happened, bonds were bidding. And you need to watch that all the time. So I hope what you take away from this uh, rant that I'm doing is that even if are not trading bonds, you must watch what bonds are doing. And bond traders are quite smart people, so it's always good to know what they are doing. Um, for our example, of course, when futures page will be available, then you can do the same thing with ZN and ES correlations, because that's what I actually do for my personal. But SPY and TLT work perfect. There's no need for people who don't want to analyze futures. There's no need to go to futures. It doesn't matter that I'm using futures for everything. SPY and TLT will work just fine. So now, I hope it answered the correlations, because first peak was in the end of June. I'm talking about stock bond correlations, and then the second leg was in the beginning of July. So those who are more aggressive and even more longer term actually had warning signs from end of June. And what correlations were positive, but it peaked in end of June or mid to end June, and then it started going down. And I know people who, when then they saw these signs, they just started reducing equities, which is very smart to do. Again, I'm more of a when it comes to my trading, I'm more of a intraday trader, so I don't have usually overnight exposure, only options. And for options, I have different strategies, because for options, I mean, one of the two. Either I want to collect premium and theta, or if I do directional moves, I also structure my trades so they move pretty slowly. But for those who are holding ETFs or equities, yeah, when you see stock bond correlation peaking and reversing, no need to sell everything, but this is the time to reduce your exposure. So this was what I wanted to say about correlation. And again, I will resume my tweets about correlation on Twitter. So uh, because there will be plenty of tweets about correlation changes, I encourage everyone, if you have any questions, just comment on those tweets and I will do my best to answer that. Again, there was also good observation from users about stocks and dollar correlation, which was and is pretty positive, but now starts weakening. Uh, so I just wanted to address that for my process, it's normal. I would be way more concerned in the US to see way negative stock dollar correlation, because then again, I would interpret that as a sign to reduce equity exposure and maybe even slowly get rid of all of it. Because in the foreign markets, same goes with Europe and emerging markets. Usually, stocks have negative correlation to the local currency. I mean, you can check euro dollar to DAX, for example, and vice versa. But US works a bit differently, because, of course, first of all, reserve currency. Secondly, structure of the economy is totally different than, for example, we have Europe. I don't want to get deep into that, but stock dollar correlations are important to watch. But if you see them strongly positive, it's there's no such thing, not no to be worried a lot. I'm worried a bit more that these correlations are going down. So yeah, I hope that helps. Now about my views, finally, because I believe on our YouTube channel we have videos on correlations, and also my weekly process reviews that I did quite some time ago on my channel. I also talk, so as a refresher, you can watch those or ask questions, and we will do our best to address these questions. Now, no surprise that because of everything I just said, and also volatility, which I will cover soon. Uh, I'm not buying this dip uh, because I don't know which dip to buy. People say, "Oh, I'm buying dip. Stocks are going up." Well, NQ is almost 2,000 points down from all-time height, and when it comes to ES, it's almost 300 points or so. So, which dip to buy? That was my question today when I tweeted about the show, and this question remains the same because. Uh, for now, from volatility perspective, ranges. I'm not talking about MFR ranges. I'm talking about price ranges every single day. Ranges in equity indices and in most stocks, especially tech stocks, are crazy wide. I mean, you see in NQ 200 points up, 200 points down. Then it rallies 500 points. Everyone is happy and then drops. This price action is it happens because of the lack of liquidity, and for a couple of days liquidity is coming back, which is a good sign. But for those who watched futures from last Monday, when there were almost no bids and offers in the order book, everything was at gaps, and NQ moved in 10-point increments. What I mean that the next trade basically is 10 points up and then 10 points down and so on. Markets are insanely liquid. And even when the liquidity is coming back, it's still illiquid. I hope it will come back because those who trade futures for a long time using DOMs and order flow know that, for example, when liquidity decreased in COVID, during COVID times, it never came back to the pre-COVID levels. Pre-COVID level, before COVID, it was common to see, for example, in ES, at least 500 contracts on every price on bid and offer. These levels never came back. So I hope at least this already reduced liquidity will come back. But for now, these ranges are just telling me that even though people are buying dip, and because of that, VIX fell, of course, even though people are buying dip, but overall market doesn't know where it wants to go. And for me, I watch very important levels. Today, I will tell my levels for futures. I encourage you to write them down. But what you need to know that futures markets actually have memory. Price action is not totally random. And when there are corrections or crashes or reversals in direction in general, basically markets move from one settlement to another settlement. That's what they do. Not a lot of people talk about these levels, but I will show something here. Why I tweeted that, for example, ES would be buy above 54.71, which of course we are quite close. And NQ is not even close to that, the level of where I would want to buy that, which is 19,700 something. But I will show you how I first view futures. As I said, they trade from one settlement to another. And if you backtest these things, you will see. But for example, so now we don't need a continuous contract, but we will go to June contract in ES. And the settlement price is this. We are still trading below where the June contract settled. These prices are important. Big players know them, even algorithms know them, and people tend to forget about these levels, but these levels are very important. Another level, and on TradingView you can do it very easily. Another level is I can tell only one thing, and you can quote me on that easily. That below 5101, I will be shorting with my both hands. And yeah, so now you know why, and hopefully you can do it for any futures contract. For those futures contracts that trade on a monthly basis or like gold, well, for gold you can use every because it's zero. But for those contracts that trade every single month has a contract like crude or so, do that at least for quarterly. So HMUNZ. But yeah, and if we go below, if we go below here, then the next target would be 48.18, and 48.18 is a price everyone should know who is trading futures. It's a yearly open for 2024. Because if we go below that, ES will turn negative, and when it turns negative, then of course you already know that the target would be December contract expiration, which I also tweeted about that. I tweeted about that, and you can do the same for NQ, but I can, yeah. So that would be the next target after 48.18. So I'm not calling markets because you know that my trading is based on intraday opening range. So I use these levels for targets. I use these levels for targets, but I trade where the market is going. And where the market is going, it basically means whether it's above opening range or below opening range. But that's what I wanted to say, that even ES is trading below June contract expiry. And if it fails to close above 45.72, or I will be very, very, very still. So for the confirmation, I need NQ to do the same because correlations are very high here. Just to show you that one, I will not repeat with NQ because you definitely can do it yourselves, but I mean, June contract expired here. You see it very well. I mean, there's still quite some distance to go. So yeah, and the biggest problem is that before that, NQ had a big rally. So I mean, the targets to the downside, I don't even want to talk about them, but they are below 17,000. I will just give you again. So this is the overall view how I use futures, because that's the main reason why I use futures, because futures have memory, and also there is another gap. There is a gap. All gaps are being filled sooner or later. But if you do settlement and back adjusted, you will know where that gap is. So if we break all these levels, there is I will just hide ranges. There is this problem, and I don't want to say anything, but this is a problem. This is a problem, and the market always closes these gaps. So hopefully it will be after 3 years in the next bear market or whatever. Maybe not now, but just keep that in mind. Because if we go to December settlement price, we will close that gap. So yeah. So enough bearishness from me, because actually it's not bearish. A lot of people ask, so are you bullish? Are you bearish? There on Twitter, and I'm not bullish. Again, I will repeat one thing, that for 99.9% of our viewers, you have no business in shorting the markets. You have no business in shorting the markets unless you are intraday trader. Because we all know that even if you are right about the crash, then volatility spikes, it will kill you to both sides. So my positioning now, I keep my money in bills. I keep my money in bills. I have no overnight exposure in my main account. I have one, again, I tweeted about that. I have one SPY iron condor for the last couple of weeks, but it's a very, very small position in my options account. Nothing else there. And yeah, I keep my biggest percentage of my capital in T-bills, and I use those. I don't know if I should say that, but yeah, I use those T-bills as a margin to trade futures. But my money is in T-bills now because I see value in having money in T-bills. Yeah, so again, I really expect questions, if not now, because I don't know how many people can are watching us live, but at least when you watch this video or when you see my tweets, if any confusion, always comment. But yeah, what I see is only one thing. I see that I'm still not a buyer, and if my uh, again, it to survive in this business, and one of my mentors said it very well again, but I mean, I will feel way better buying higher, but when I'm sure about the signal. I'm not saying I'm sure about market direction. No one has a crystal ball. When I'm sure that all the signals line up, I will be way more happier buying higher. Here I see no business in buying. Yeah, so that was from me. So now we go to Ted, I believe. So Ted, do you agree?
That was an awesome presentation. I really appreciate that. I learned a ton, and I hope everybody watching did as well because that was really good. I can't hold a candle to it, but I'll share what I have. Let's see here. Share the screen. All right. Everybody's familiar with my format at this point in time, I think. So, what I'd like to do is just touch on macro regime, policy, positioning, and spend a lot more time on market signals and trades. We live in interesting times. I thought the last time we met on 7/31, we were all sitting at a very critical time, and it did prove to be the case. So let's talk about it. Again, my favorite macro strategist has us in Goldilocks with a deflation orientation. Can figure what that means. But what I'm seeing is growth is stable. At least all indicators suggest as much. Inflation continues to trend down. We do have CPI in the US tomorrow. We have a tight Fed. Whether you think it's tight or not, it's 2.5 to 3 points above inflation. We have employment weakening, and last time we talked a little bit about the SOM rule, and I'll hit on that a little bit. It did trigger, and we saw a pretty wild bout of volatility that actually we saw on 7/31 continued on 8/1 with the employment report, and then certainly, or 8/2 with the employment report, and then continued thereafter. So just a quick perusal through some of the growth indicators. GDP now, Atlanta Fed, plus 2.9%. Growth is solid. You can see they're well above the blue chip consensus, which is in this band of like, let's say 1.5 to 2.5. Atlanta Fed's running high. I haven't charted this yet, just because this does shift all around, and we do have retail sales this week to contend with. I noted that yesterday the National Retail Foundation reported July retail sales up 0.092. It's not the same exact number, but we will see numbers out on Thursday for US retail sales. And that is a huge input in terms of the overall GDP for the United States. And so it's one that we need to pay careful attention to as it will affect that number. The other thing we talked about last time, we saw ISM manufacturing was down pretty dramatically into recession territory. The following week, last week, we saw some relief with ISM services up to 51.4 out of recession territory. As you can tell, this thing's bouncing all around. It's not giving us a clear trend in terms of where it's going, but we're vacillating at a sort of even pace economy. It feels like, and so that's what the data is supporting. We reported on this last time just before the Fed meeting. We had PCE out. It was up 2.5% year over year and continues to trend lower. Today, we had, and really, I think it's arguable that this was the catalyst for today's move. You had producer prices drop to plus 2.4% year over year from 3.0 the previous month. Certainly one data point does not make a trend. And I am somewhat concerned that the market front ran CPI tomorrow, so CPI better not disappoint is all I can say. In terms of CPI, which is tomorrow, this is Atlanta. I mean, I'm sorry, the Cleveland Fed. They're pretty good, and they almost nail the number every time. They adjust it daily after each data point comes out. They're at 3 for core CPI, I mean, for headline CPI, and 3.33 for core, which aligns pretty well with where we were last month. So we're not going to see much of a change. So any sort of numbers bigger than that, higher than that, are going to be a problem. Lower than that, perhaps we get some reinforcement in terms of market price. Talked about this last time too. Fed remains tight. And just as we were kind of concluding remarks, I asked, will the SOM rule trigger? The SOM rule basically measures 3-month rate of change of the unemployment rate. Unemployment rate came in at 4.3%. The SOM rule triggered. The SOM rule says that once it triggers, you are in recession. But of course, Claudia Sahm herself came out and basically said, well, it's worked 13 times, but out of 13, but maybe not this time. So, but when we saw the unemployment report, not NFP, which was jobs, and that was weak, but more the U3 or unemployment rate come out at plus 4.3%, we saw the market head south fast. And, related to that, obviously, we saw a big spike. This is on 8/2, so we met last time here. We were on 8/1, and we were just after the Fed meeting, which was here. And then we saw a Vol Friday spike following that report. We also saw the yen, which had been strongly running higher, continue to rip. And then we saw the Nikkei basically crash. I think we were talking before the show last time. Are we buying the dip in the Nikkei? And this was Friday. It closed lower and then gave it up on Monday. So basically, I think you could call that a crash. I do. And I wasn't long, so I was good. And then, of course, in the US on 8/5, August 5th, we saw this crazy vol spike, which people have spent a lot of time analyzing because it is an oddity, and those that know vol a lot better than I do were saying that it didn't really print 65. It printed 65 maybe in the pre-market. Whoops, sorry. Goodness, hold on a second. I got to go back. Sorry. My apologies. I got carried away with my mouse. Sorry about that. I'm trying to go back. I want to spend some time on this. I apologize. There we go. All right. So coming after in the middle of last week, Dean Kernot, who runs the Alpha Exchange, does a decent podcast. He put this chart out, and this chart basically shows on August 5th, we had a 3% down move in SPX. We had a 65%, I don't use percentages to measure vol, but he did in this instance, 65% move in the price of VIX, or 15.2 vol points. He commented that the most critical insurance market broke, and this wasn't 2008 or 2020. Have to say this is really worth spending some time thinking about. And I kind of went through this and I looked at it, the 2.5 references Volmageddon, which was a short-term event, didn't really affect the overall market for a long period of time. It is somewhat analogous. We certainly have had a big short vol trade, lots of structured product, people trying to harvest yield outside T-bills. This could be an analogous event to Volmageddon. But the point is that this was really an aberrant move. And Goldman Sachs commented that VIX futures liquidity was at its worst ever levels. So that's not particularly bullish. People pull their horns in. And it's like Vi said, the liquidity is just not there. So I'm not particularly bullish either. Keep hitting that. I'll go back one. Apologies. Want to kind of go over this where I am in terms of my dynamic positioning portfolio. When we met last, I was at 29% bonds, which that stock bond correlation really helped me out because I was only 3% in equities at that time. I had some exposure to commodities and some alternatives and to currencies. And I continue to have the exposure to currencies, but it's a different mix of currencies or percentages of currencies that I'll talk about. My cash position has gone to 63%, and it's mostly because my bond position came down, and that was primarily a function of taking some profits because it worked really well in the time frame, but more importantly, realized volatility increased, and my position sizes needed to come down in order to be in line with position sizes. And I also got some weekly sell signals that I'll talk about as we go through this presentation. So from a market signals point of view, you have to ask yourself what's going on. And I don't think really anybody knows yet. But what I wanted to share with you today is, and I'm starting out with the yen. We talked about this last time. This is a weekly chart. I have counter trend signals that help me get long. I'm mostly trend following, but I also have counter trend signals that help me get long. I was able to get long FXY, which is a ETF for the yen, long yen, back in the beginning of July timeframe. That worked really, really well for me. And then, of course, at the end of last week, we had a sell signal in the FXY. On the daily chart, this is my trend level, which is time series price momentum 3 months, and you'll see that throughout my charts. Blue is bullish, red's bearish, black is neutral. But you can see here getting long in this time frame, early July, and then when this thing, I start taking profits if we get this parabolic move. So we got a parabolic move here on Friday. I took more off on August 5th, which was the Monday, and then I had a weekly sell signal. So I took whatever I had left in my FXY position, I took down another 25%. It's still bullish, decent price action today, but it's very overextended, and I'm not a buyer here. Likewise with the Swiss, I've been long the Swiss for quite a long time. It hasn't really done much of anything. I didn't really get stopped out during this little pullback. And so last week I got a sell signal on FXY. So that caused me to, I did sell some on Monday to take profits, and I took 25% of my position off when I got the sell signal on Friday. I do use these signals at the end of the week. I wait till about 3:30 on Friday afternoon. Whatever signals are showing up on the weekly chart, I use it. Now, these signals are not foolproof, and again, you're fading the current trend with the hope of taking profits in this instance, and maybe avoiding a worse decline, or B, you're using it to get long a new position that has been maybe bearish and starting to show some positive price action, which is one of the positions that I'm now in. At the end of the day, Friday, I got a bullish signal on the weekly chart. It had already moved. This is FXA, which is the Aussie, long Aussie. And so that caused me to get long right here. And we've had a couple of decent days of price action. You can see my trend line is here. It's a bearish scenario. I fully expect this to pull back. I have a stop loss, and I don't use anything in my trading system. I mean, in my platform. But if you look at my FXA, my stop loss is set at 64.22. So if that triggers, I take 25% of the position off immediately and then continue to take that off each day while it stays triggered. On FXC, which is the Canadian currency, the loonie, also had a signal, got long there, got long here, have the stop in place. It is neutral trend in my book. UUP, this one's probably not going to work out. This is the dollar. You can see I got the signal to get long dollar. I had not had any dollar exposure since we sold off back here. I did get long right here. I am underwater on that position. My stop is somewhere in the neighborhood of, let's see, where is UUP? UUP is, it's right down in this area here. So I give myself a little bit of leeway on the position. It doesn't look good for me, but I don't take it off until my stop's hit. I also got a signal long this week. And you look at these price charts, by the way, I don't get these signals very often. So when I get them, I take them. But I had a lot of them this week, so that's why I'm sharing them. So I got a long signal in PDBC, which is a commodities ETF, mostly oil weighted. Of course, we've got geopolitical tensions uh, rife right now, and sort of that may be driving the oil price because oil's been really bearish. I got long here. Arguably you should be shorting it. To me, this is like we rallied right off the bottom. Then we got this red candle. If I were shorting, I would short this here. My hope, I guess, from a trading point of view, although I'm not trading on hope, is that this thing, comes down a little bit and starts to go higher. And that's how I build a position. So if this starts taking out these local highs, it starts to move into bullish trend, I will start adding to the position if it carries forward. TLT, similar situation, got a sell signal at the end of last week. Took profits into this parabolic move that took place on Friday and Monday. Took off half of the balance or quarter of the balance of my position on Friday. I have a small position. It is still bullish trend. IVOL, we talked about this is a play on interest rate volatility. I'm sorry, on the steepener. And I got a signal on that last week as well. Had this sold into this rally on Friday and then took off more of the position. So I have a very reduced position size here. It seems to be trading well, continuing to go higher. I still have a small position. TUA, which is a short-term interest rate play, similar, gives you some leverage in terms of short-term rates. If the Fed cuts, this should continue to go higher. This gave me a sell signal last week. I took some profits in here. I sold some here. I still have a position. It is bullish trend. So it looks like it wants to head higher here. And so, I'm going to have to wait for a pullback and for the chart overall to improve. We keep hitting, it's funny because Raphael and I keep talking every time we have this last 3 meetings on gold, which I sort of bring this up just for this reason. We met here, we met here, and here we are here. So I took some off yesterday because we may well see this. I don't know. I guess you don't have triple tops. This thing has really struggled to continue at all-time highs. Maybe it goes higher from here. I did take some off. It's just not. It's just at the top of a range that I'm not going to buy into. VIX, we've talked about that. This obviously was in a long lull period. It's funny if you go back and look at the charts that I was showing a couple months ago or a month ago, this seemed like a pretty big range. And now, of course, we've had this range expansion. VIX has pulled back. Still bullish trend in my book. So something to think about as it gets oversold and as we head into CPI and retail sales. I did not get long and I've not bought the dip because my indicators coming into the end of last week were still on a sell signal, even though we had this nice sort of reversal. People who have gotten paid 2.7% so far this week, I didn't get that. So it is showing some positive signs, but I'm not long, and I've got it at neutral trend. Maybe transitioning into a bull trend here, but it's right in the middle of a range. I was telling Raphael earlier today, if I were going to short, I'd wait for a little red candle and then I'd short the thing. You can see that the volume and this little run up has been thin, although we did get some pickup in volume today. Similar situation with SPY. Again, thin volume. It is kind of trying to break out of this neutral to bearish trend. If I'm going to buy this, I need to see this come down. It needs to make a higher low before considering moving long. In conclusion, what are these charts? These are all daily charts I'm going to show you. These are all defensives. In the last two sessions, I did talk about the defensive ETFs. This is high dividend. I mean, this was the crash day for SPX and Qs. Yeah, you had a big red candle, came back to a middle of a range. It is not. It's continuing to show decent strength. Same for low volatility, SPLV. A little bit of a stronger pullback, but money continues to flow into defensive sectors. Same for XLP, same for real estate, XLRE, XLU. These are just not the same charts. They're continuing to attract flows, and XLV, which is healthcare. So we have defensive sectors performing really well, continuing to perform well, relatively speaking. And we have SPX and Qs on neutral trend, and I am not yet a buyer here, and I don't have FOMO. So that's what I got.
Okay, so tough to come after you guys. You delivered a lot of data, and I'm still trying to process everything. But okay, I'm gonna try to remain at the levels you are bringing tonight. So basically, I want to come back to the correlation quickly because I think it was very important, and Vi addressed it masterfully. So I would encourage people to watch again. So basically, the way I see it, to tell it in normie terms, why is the fact that the correlation flipped was important is because when you have this kind of inverse correlation, it can mean only two things. Either we are moving into a deflationary recession, or it also happens when you have nominal growth that accelerates with activity that is resilient. So it's only in these two scenarios, that you have what you saw with the correlations. Clearly, market participants chose to focus on the fact that it was a move into a deflationary recession. They went so big into this narrative that they pushed the expectation for a rate cut at the next meeting to 0.5%, which in my view is disproportionate. But this is what happened. This is the reason why we had the setup. Now, regarding this currently inverted correlation, I'm in the camp of thinking that growth is actually resilient, and that I'm expecting this currently inverse correlation to actually go back up. I can see two reasons why the correlation will go back up. The first one is from bonds pricing a less aggressive cut. That's the first reason why I would see the correlation moving back up. Or equities pricing less of a volatility premium. So in either case, because I consider the growth to remain strong, I chose to actually buy the dip in equities. Okay, so obviously today I cut everything, and I will address why in the charts. But that's my current reasoning. I'm always open to being wrong. Of course, I use stops, etc. But that was my reasoning. So now let's go to the charts. Okay, share. Okay, do you see the screen?
Yes, we do.
Okay, good. Let me arrange so I'm not bothered by anything. Okay, good. So thank you. So what happened was, at least in my book, so I saw several stuff. the first thing I saw was I got some buy trigger. I got one that happened too early on the 30th of July, right before the big sell-off. I still need to investigate what happened. This one was clearly wrong, but the next ones were right on the spot. And the good thing was that they triggered as NQ, ES, and other tickers that I will address were actually testing the low of the long-term range. So, which is a very good spot for a potential bottom. So you can see here on the 1 hour, this is the normal range and long-term range. So we had the cap and we got the test twice rejected, and then poof, we got the move back up. Also worth noting today, the cap on the lower end of the ranges is gone, because now you have the bottom of the normal range that is starting to go back up. ES actually exhibited the same pattern. You got the sell-off. I didn't get to buy in ES, unfortunately. We went to retest the long-term range, and we started to get the bounce. Let's go back to NQ daily. So my ultimate target was to get back to neutral trend. This is usually what happens when you get this kind of buy signal. The second step I'm currently expecting, I will tell you why it's a bit how to say. I keep in mind what Vi is saying about volatility, etc. when I will address some particular ticker that looks absolutely disgusting, and a reason why maybe I can understand why people choose to remain in cash. But anyway, so the first target was to get into this neutral area. And what I'm expecting is I don't think this move has more energy to go literally like a V-shaped recovery back up. I think it's gonna do what it usually does. We get to neutral, we get some kind of rejection to retest a lower level, and then finally we confirm the breakout above the bullish trend, and we start the move back up to all-time high. So this is currently my thinking. We shall see, and I have some reserves. I will tell you afterwards. But this is what I'm thinking about NQ. Yes, you can extrapolate with SPY, QQQ. It doesn't matter the way you trade the US equity market. On the other side, so DAX actually exhibited the same pattern. It went to retrace the long-term range. The problem is volatility is very, very elevated. So I didn't touch Europe. CAC looks absolutely like dog shit. So it went to retest the long-term range as well, but we are very far away from trend. Actually, the one that looks the best is FTSE. FTSE retested the long-term range, bounced, and it's actually trying already to attempt a cross of MFR bullish trend, and it's actually already crossing my volatility trade and trend level. So I would say in Europe, the most bullish one I see is FTSE. If you really want to buy Europe, I would focus on this one. Another dip that I bought was Nikkei. Nikkei actually is a system nailed it perfectly. What I got was a buy on this crazy minus 12% move. And I got a trigger, here. I got the trigger here at 31K, so basically right at the bottom. So this one was a nice one, but it's not as good looking as the US stock market. The volatility is very, very high. Trade of vola is still pointing higher. So here you were basically catching a falling knife, and you had to have conviction in the macro view to buy it. So same as for the US, I exited everything as we reached the trend. Now the question is what happens? So I'm thinking we should get on the macro the same kind of price action that I'm expecting for the US. So basically we try to break trend quickly. We go maybe to the top of the trend. Then we have a move down. Nikkei tends to be more aggressive on the retest. So I think I'm expecting this kind of move. And then same pattern, we break back to bullish trend, confirm the move to bullish trend, and then we go back up. So considering my macro view, this is what I'm expecting. Now going to TXY, so the dollar. So in the last show, I was expecting a retest of trend, so we got the bounce test of trend and the rejection. Of course, I didn't expect this kind of crazy move down in the dollar. And what I didn't expect was also the correlation to be that positive. So UUP versus US market was actually positive. So as I was betting for the dollar to go down, little did I know that I was also betting that we were gonna have the correlation pushing the market lower. So this is something I missed, but if you saw that, good for you. Then let's go to the VIX. So the VIX was a big fail. I really expected to have more time before we got this VIX bounce. At least the trade and trend system worked. We crossed, and then the trade and trend accompanied VIX into the move up. The only issue is that we never got the retest of trade, which was what I expected to buy puts. A good thing for bulls is that on the 8th, we rejected trade and trend. On the daily, this is here. So we went below, tested, rejected. So this was a confirmation. I think at that time, yes, we had a quick sell-off to 5,200. So this was your signal to, if you wanted to buy this move, this was your signal to buy the move and place this bounce. We had confirmation of rejection of volatility, trade, and trend. So I hope you saw that and that you did. This is for VIX. Now CL, so we've seen quite a good move up on CL. The only problem is that, in my opinion, it's just a chop. So we are just chopping. So if you can see something in that, good for you. I'm not seeing anything. All I see is volatility just chopping around with no direction. So gold, I think you will like this one, Ted. So I'm actually very bullish on gold. I really like the fact that volatility is clearly now pointing down. We have trade also clearly pointing down. So I'm actually expecting JC to go retest the top of the range before getting some kind of consolidation before another move back up. We are still not close to the minimum I mark for the daily trade, where I would consider a reversal possible, or at least a pause for JC in his bullish momentum. So for now, I'm expecting gold to go to top of the range, consolidate, and then continue to move up. This is my thinking currently, based on what I see for volatility, which, in my opinion, has stabilized. Bitcoin actually, in my opinion, looks like CL. So it's basically very choppy, no clear direction, very, very tough to trade. I got a buy signal early on the 24th of June, but the problem is we had a huge sell-off in risk assets, and of course Bitcoin felt this move. It retested the bottom of the long-term range. If you were awake or monitoring Bitcoin as it was happening, very good for you. You had the same kind of bounce we had in NQ and ES, test of low of the long-term range, retest of trend. This is where you get out, or you can sell some and put a stop at your entry or at profit if you want. But if you bought there, I would have gotten out at trend. A very, very choppy Bitcoin. Now I'm going to yields. So as I've been mentioning for several weeks, volatility of yields have been moving up for quite some time. And when volatility goes up, what you get is an asset that goes down. What is true for the 2-year is true for the 10-year, is true for the 30-year. So the blue is the volatility. You can see it clearly rising up. Trade, so black line here, is also rising up. So to come back to the correlation stuff that Vi mentioned, if you are monitoring yields going down, so bonds going up, and you saw the change in correlation, the bet on equities going down and bonds going up was the right one, if you saw that. Now the question is, what happens? So my current thinking is, considering where the volatility is for the 2 years, the 10 years, the 30-year, I would expect that bonds could have reached, sorry, not bonds, yields could have reached the bottom. So I'm seeing little upside in vol right now for 2 years, 10 years, 30 years, meaning that the most probable course of action that I see for the next few months is basically chop. I will expect yields to be in what I'm calling here a chop box. So we will monitor, of course, in 2 weeks and in 1 month, every 2-week show. But this is where I'm expecting yields to be stuck for the next few months. And if so, it will give the time for vol to stabilize, trade to stabilize, and so volatility to go down, trade to go down. And what it means is the next move in yields should be a move up. So this is what I'm considering right now. Now to conclude, I'm going to go to the big stocks. And like I said, they look like, most of them, not all of them, but most of them look like crap. So Google, this is Google. So very bearish, very, very far away from trend. Volatility is still rising. As it topped? Maybe, but I'm not touching that. Trade is still rising. Microsoft looks the same. Very far away from trend. Volatility is still rising. Trade still rising. So you have a lot of steps before you can consider these big stocks that are moving the equity markets to be at least buyable. So the only one I saw was Meta. We talked about it before the show with Vi. Meta was the one to get back to bullish quite fast, and its volatility is going down, trade is going down, it's pointing down. So this one actually is the one that looks the best. But others, even the beloved NVDA, which is actually testing trade, but volatility is still very elevated. Trade is still very, very elevated. So we have a lot of steps before you can consider buying those. So that would be the, let's call it my bear case in relation to what I was thinking about for NQ. So I saw a question regarding the fact that someone wants to know how to use the trade, for instance. So let's take NVDA as an example. So what you would want to see to confirm that, for example, NVDA is now buyable again, is you'd want to see the volatility go down you'd want to see the trade of volatility go down, and you'd want to see volatility actually retest trade from below. Exactly what happened here in May, for instance. You have elevated volatility going down, and testing trade from below. Once you get this kind of price action, you have a confirmation that volatility is pointing down on different time frame. So the volatility itself, but also the trade of volatility, which is a larger time frame. And then what you get is this kind of move. So this is true for every asset. So I hope it will answer the question that was raised. So yeah, that's it. That's it for me. I hope I didn't take too much time. And yeah, Vi is gone. Okay, let's go to the questions. So one question was, can you please discuss Volatrade and Vimomo for entry and exit? Break of Volatrade price and Vimomo is good exit. Appreciate more info on your process. So I did a video itself on how to use my trade and trend script. So what you want to see in a bullish asset is basically what you want to buy. You want to see trade pointing down. You want to see volatility pointing down. You want to see trade pointing down. You want to see volatility in every time frame pointing down. You don't want to buy something with rising vol, rising trade of volatility. So I would encourage you to, again, go watch the video I did about that and check every asset that you are interested in versus the volatility indicator. You will always see that you get this crazy ramp up, or at least this bullish divergence only when volatility is going down on different time frames, be it volatility itself and trade of volatility. As for
yeah, I can explain. Yeah, I'm back. So Raphael, I'm sure will be able to add because I know that he's also using it a lot. But first of all, you need to on TradingView scroll through at least a couple years of data for the asset you are interested in to see what ranges in Momo are normal for each asset, because for very volatile assets, these levels will be different. But for majority of assets, +2 and -2 are a good place to start. So of course, it's not an fixed oscillator like others, where it has a limited value on the upside or downside, so it can go to any value it can. It's not limited, but 2 is a good place to start. And now what you need to look for is when for longs, when negative momentum is turning. First start with 10 days and then move to 30 days, because that indicator is called pre-time frame. So the very important thing is to not only do like, for some reason, a lot of people do with technical indicators, where if it touches -2, doesn't matter what it's doing, I'm buying. No, but we'll wait for reversal. Same for closing the positions. Of course, you can use it for shorts as well, but like I said, I'm not very big advocate for retail shorting. But for selling the stock is the same. When it's positive, goes positive momentum and reverse. That's the timing aspect of the entries and exits. So I hope it helps. Raphael, maybe you want to add something.
Yeah, I think what you said is quite right. For momentum, I'm always looking at the extreme. I mean, I explained in a different video how you can use to maybe build a position.
Yes.
But I'm mostly using for like at the extreme. I like to buy the dips. I like to know when maybe something is about to correct. So
Yeah, but like you said, the extreme is different for every asset,
yeah.
because the extreme for Coca-Cola stock will be way different than the extreme for Tesla stock. For Coca-Cola stock, in most cases, unless something really bad happens, I mean, at -2, you can buy some. I mean, But for Tesla, I saw 5 and -5, same for Bitcoin. So I mean that number can go up and down to where it needs to go. So.
There was one question regarding, I guess it was regarding the trade and trend on for USO at two particular dates. So
Okay.
The issue was in this example for USO is that you're looking at an asset that is not trending. So it's very easy to see with the eyes that first USO is like it's in a chop. It's been in a chop since at least April, and sure, it's big moves, right? You are going from 82 to 71, then back to 82, then back to 72. So it's very nice if you can trade both sides, but you are not trending. If you want to see a trending, what actually looks like trending, and you can check the vola indicator for that. It's, for example, 29th of January to 10th of April of 24. And if you want a trending bearish price action, you can check from 6th of November 23 to 17th of January 24. This is what you are looking for. Okay, so of course you don't know before, but there are signs. Look at how the vola indicator is behaving before this kind of stuff happens. So because this person was asking for particular dates regarding this indicator. There are no other questions, just this person. I'm just making sure we answered everything she asks. Yeah, the break of vola trade. Yeah, the problem is again the break of vola trade, or it's like the break of trend. You need to have a trending asset to consider it as significant. Let's say you are looking at an asset that is not trending but chopping, and you are putting weights on the fact that it broke its trend or it broke its trade. It doesn't matter much because this asset was not trending. If you have an asset that has been trending for some time, you have a clear trade pointing down, vola going down every time retesting trade, still compressing and compressing, and then you have a break of trade. Usually the way it looks like, you're going to see volatility rise above trade, retest from above, and then volatility will go back up. Then this matters. So you want to trade, you want to use the trade and trend indicator on trending asset, not on choppy asset. It makes no sense. I think Vice said that in the past also. It's better to use ranges for non-trending asset.
Yeah, for assets that are relatively lower Hurst exponent, and basically even without Hurst, you will see it on a chart. If you see asset which is ranging, and if you prefer to trade these, because mean reversion and range traders are different breed from what I trade, but yeah, that's how you're supposed to trade ranges. Basically, use upside downside ratio and execute as close to the range high and range low as possible. Correct.
Okay, I think we are good. I'm checking one last time. I think we are good. There are no more questions, and I think you guys went quite deep.
I hope it will raise some questions, because at least I think it should raise some questions. So, yeah, interesting show. I hope it was useful, and we are live for almost 1.5 hours already. So if there are no questions, I just want to thank everyone for joining. Thanks, Ted, Raphael, and thanks for everyone watching. And manage your risk. And like I said, cash is a position, and no need to feel if you were, for example, sitting in cash that you are missing out. Because when volatility is high, there is a very big chance that actually you are not missing out at all. So yeah, for now, I will stay in touch, and if there are any updates, of course, I will tweet about that. So thanks again, everyone, and have a great 2 weeks. See you soon.
Yeah, on Thursday we may do the ticker show again.
Yeah, sure.
Where you can send some tickers for ranges and trends. Thank you, guys.
Thank you.
Take
Good to
care.
see you guys. Take care.
Bye.
Bye now.